So there's been a lot of talk about the S&P 200-day moving average, which breaks of that have typically preceded some choppy price action. So this volatility isn't really anything new. The demarcation point that we're watching right now is the S&P 80-week moving average. If the index closes below that on Friday, then there's heightened risk for more bearish price action, in our opinion.
Which would mean what?
Which would just mean, there's a heightened risk for stocks to decline even more. Breaks of the 80-week in the past have, been an indicator for stronger sell-offs, at least compared to the S&P 200-day. So that's the trend line that we're watching.
There's been a lot of talk about death crosses with some of these FANG stocks as well, moving their 50-day average moving below the 200-day moving average. That happened last week, I believe, with Google. This week it's concerned with Netflix. What do you think about those sort of situations, and what do you have, if anything, on that specific situation?
So we've actually done some research on death crosses, and they're not as ominous as they sound, at least in the past couple of years. The 1 month return after a death cross is actually stronger than a golden cross, which is the opposite, obviously.
Yeah.
So we're not putting too much stock into the death crosses right now.
Gary, I know that you look at things a little differently, just from a fundamental perspective and what some of the headline risk is out there right now. You heard what Andrea just said from the technical perspective. What are your expectations based on what you're seeing?
Well, Becky, we're getting more optimistic at the Hodges Small Cap Fund. Earnings have been awful strong. They were great in the second quarter for small caps, up 48%. They'll be up over 30%. In this third quarter. Yes, earnings are slowing, but we think it's now time to play offense. And what we've done in our portfolio is we're concentrating the portfolio in our most convicted ideas. We've gone from about 60 names to 50 over the last couple of months in our most convicted stocks whose earnings we think will hold up and a slowing economic environment, but do exceptionally well in a strong environment. So we think we're just in the middle of a correction. The consumer's strong. 70% of the economy is a consumer. Corporate confidence is high. And so we don't think it's the end of the world. And honestly, we think there could be some upcoming catalysts that could really make the market rally into the end of the year. That catalyst, we've got the Fed Governor Powell speaking. Maybe he starts talking about slowing the rate of increases down with the Fed rates. We've got the G20 at the end of the month. We think Trump would like a trade deal. She would like a trade deal. Maybe something positive comes out there. So we're not as negative. We think we're just in a correction, and we're getting our portfolio ready for a rally towards the end of the year.
Gary, let me ask you just quickly, what are some of the names that you're trading into, your favorite stocks if you're consolidating right now?
Well, Becky, we've been buying Texas Roadhouse of late. Here's a restaurant company that's had 35 consecutive quarters of positive same-store sales. They got dinged a touch last quarter with increases in labor, and they had a one-time insurance cost. But they say they're going to be able to raise prices 2% this next year, a 5.5% comp last quarter. Business is great there. We also think the energy stocks are oversold. As Joe mentioned earlier, crude's down $20 in the last couple of months. We love Diamondback Energy, the low-cost producer in the Permian Basin. They'll grow production 50% this year. Earnings will be up 50% and cash flow up. So we've rotated in some of what we think are the best companies out there that we think will outperform going forward.